We move on. In a major blow to debt fund investors, proposed amendment to the Finance Bill 2023 is likely to take away the benefit of 20% tax with indexation benefit that mutual funds currently enjoy. In fact, the Finance Bill has been passed and now this benefit is removed. Now it will take away the tax advantage that debt funds enjoyed over fixed deposits. Now, to explain all of this, understand all of this, we are joined by expert panel to analyze how this decision will impact investors and mutual fund industry. Let's welcome on board DP Singh, Deputy MD and Chief Business Officer, SBI Mutual Fund; Dhirendra Kumar, CEO, Value Research; Arnav Pandya, founder, Moneyeduschool. Good evening and welcome to a very special edition of The Money Show, where we will understand the impact of LTCG with indexation that's gone away from debt mutual funds. And let me just come to Dhirendra first, because we really need to understand this. So the Finance Bill, Dhirendra, has been passed, and now what will you tell or explain to a conservative investor who was maybe looking at this category owing to the tax benefit over FD?
A conservative investor, he has a choice of, his alternatives are investing in a debt mutual fund and making a bank deposit, or going for a small savings scheme like PPF, post office MIP, any such thing. Indian investors and all other alternative except mutual fund, they provide you somewhat like a guaranteed return or assured return. In case of mutual fund, you don't get an assurance, but there was an advantage. Assuming you made a 1 lakh rupee deposit in a bank and you earned some interest in a year, whatever, 7%, 8%, that was at your taxable income. If you invested 1 lakh rupee in a mutual fund and that money remained invested and you kept holding it for 3 years, it was considered a capital gain. It was not considered an income. And because it was capital gain, it was adjusted for the inflation. The cost inflation index is announced by the government in every budget. It was adjusted for that. And whatever was your appreciation, whatever was your return over and above the inflation, that was only your taxable gains. So that benefit is gone. Now, all that you earn from your bank deposit or your mutual fund will be taxable, will be considered as your income, and it will be taxed according to your rate, to your marginal rate of taxation. If you happen to be a person who is not supposed to pay taxes, you remain tax-free. If you happen to be a person who pays 10% or 20%, so you pay only that percentage. We have been used to this advantageous, advantageous taxation treatment of the debt fund. Now that advantageous tax treatment is gone. But still these debt funds remain attractive because you can plan things much better with these debt funds. If you invest in a debt fund and you hold it for 10 years, you don't pay any taxes for the first 10 years. It is a great tax deferral vehicle. Besides that, it gives you the diversification. Besides that, the money is always on demand. You can get your money back in 24 hours, 48 hours, anytime, on demand. This money is on demand, unlike deposits and bonds.
Let's also get an industry perspective. DP sir, how do you look at it as industry representative? What kind of a blow is it?
Oh, it's Kavita. First of all, thank you very much for having me on the show. And I think it's disruptive because we have been used to having this benefit for years and decades. So it's definitely a new era in the mutual fund debt schemes. So that point of view, it's definitely disruptive, and the narrative which the industry has been giving to the investor, that is not only having the benefit of liquidity or managing your weights, capital gain, where tax is not to be charged at accrual basis, but at the time of the withdrawal or redemption only. The third narrative was that it's having 20% tax after indexation. So that narrative is gone. But as Mr. Dhirendra Kumar has rightly said, but this continue to be still an attractive proposition. It's definitely, we are feeling that it has come out of blue. It was not being discussed, and since it was not in budget, nobody was expecting it. But whatsoever it is, we have to look at the business plans, look at the new narratives of getting to the investors. But from investor point of view, debt funds still continue to be attractive. And mind it, the existing investor don't have to worry, because for them, whatever the rules are there will continue to be there, and only the investors who are coming from 1st April 2023, they will be subjected to the new rules.
That's a very important point. The existing investors don't have to worry about the tax benefit not getting, because they will get. And also, the part that you said, Mr. Singh, that, this category in itself is provides you with a design or structure which is very investor friendly. So that fact still remains. But the question to you, Arnav, now will be, so debt mutual funds is not only utilized to park in money for short term, people also use it to park in money for long term, and also for retirees and pensioners. That's a very important aspect. And if you take away the taxation benefit from there, it will be very less attractive, because now it comes at par with the other fixed income instruments. How do you look at it, Arnav?
Yes, that is definitely the case, because if you look at data and if you see the investor behavior over the last few years, we see that over the period of time, retail investors have been increasingly, but in slower manner, still coming to debt funds to meet various objectives or goals which they have set for their own financial planning process. So now you look at it, that see how the corpus of target maturity funds, long-term debt funds, these have increased, and this is a clear indication of the fact that people who are planning long-term are also using these funds to meet a part of their goals. One of the biggest advantages there obviously was the fact that over a longer period of time you get the benefit of indexation, so your overall tax rate comes down. Now that benefit is gone in, so whenever people are now going to plan in the future, they will also need to take this factor into consideration. So as you plan for your overall finances, one thing is very clear, that it's just not the tax benefit which determines where you are putting your money, but also the fact that what convenience does it give? What kind of liquidity is there? Do you get your money when you actually want it to? All these factors play a role in the overall process. So while short-term impact is less, because obviously even now if you see the guidelines, up till 3 years, the gains were anyway short-term in nature and they were taxed at the marginal rate of tax. Now every capital gain will be taxed at the marginal rate. So investors will need to do a rethink and their working, because this is definitely going to impact their long-term planning, and they will need to either look at other options within the mutual fund space itself, which can give them a debt exposure but still not have this kind of taxation if this is not palatable to them. Or the other option obviously remains that you defer the tax and sell the units only when you're comfortable with it, or your applicable tax rate is lower, so that you do not suffer at the highest marginal tax rate. But this entire process will need a complete rethink on, in terms of the planning that an individual is doing, how they are using these funds, and how are they going to go about the process in the future.
Dhirendra, so now what it looks like is it's all about becoming a smart investor and planning your investments smartly. Now, just talking about the fixed income options that an investor has. After this particular change, among the fixed income instrument option, which is more attractive? Because now we need to set parameters and look at each and every fixed income instrument. What parameters would you apply in case we want to compare all of these investment instruments?
Fixed income funds are extraordinarily attractive because of their liquidity. When you invest, when you do a PPF, open a PPF account, you are stuck for 15 years. When you do a post office MIP, it's different. Your money is stuck and you're getting your income. In case of mutual fund, you get all the flexibility. You can set up your SWP. In case of emergency, you can pull your money out anytime. So it's the liquidity which provides you a great advantage. And I think every investor must have this allocation, a part of his allocation. I think there are many investors in India who are long-term fixed income investors. Long-term fixed income investors, they should go with the vehicle which is the safest, because your need for liquidity is not there. But I think for every investor, 10% of your money should be into fixed income funds, simply because if you want to rebalance, assuming the market goes down, and you have chosen to have 50% into equity, but of that have 10% into fixed income fund, because that is the only thing which the money which you can get in 24 hours. And if you want to invest your money into an equity fund at an inopportune time on a special opportunity for rebalancing your portfolio, you can do that. So I think there is still a case for it. Anyway, these vehicles were greatly, attractive, or they're a useful vehicle for companies who park their surplus in the liquid fund, the money market fund, and also the short-term debt funds of many kind. I think those are the funds which is useful even for investors. Investors should steer clear of the sophisticated category that has been created. This 16 kind of funds, reason being, most people don't understand, and most people are also in for a surprise, because many of these funds, they are exposed to the interest rate risk. When interest rate go up, these bond funds go down in value, and normal investors, individual investors, are unable to reconcile with that decline in value. Besides that, there is a credit risk, but credit risk, I think, is fairly well managed in the mutual fund case situation. So one should only consider, individual investors should consider short-term debt funds, and rest of the investors, for them, life is as usual.
But then, DP sir, now let's talk about debt mutual funds, okay? The SEBI classification classifies them into 16 different categories. As per your time horizon, your risk appetite, you can just take up any one that suits you. Now, these are also just open-ended, by the way. There are other different benefits that you have in debt mutual funds which are close-ended also. There are so many other FMPs which are theme-based. Looking at this entire bouquet of debt mutual funds, now it's very important to understand the step that the industry might want to take to maybe innovate or just add on some other benefits to these categories or to these funds. Do you see this coming? Because as a product structure, it is a fantastic product structure. How would you innovate? How would you make it much more investor friendly?
Oh, Kavita, as you rightly said, there are 15 categories, and when these categories were made, the existing tax laws were also taken into consideration. For example, if we talk about equity hybrid funds, because the CBDT circular says if you are having more than 65%, it will be considered as equity fund. And the same way, there were the other debt fund. But now what I foresee is another category will emerge, which is between 35% and 65%. Because as per the finance bill, any fund which is having less than 35% into equity funds will not get the indexation benefits. And it implies that any fund which is having more 35% or more will be having the indexation benefits. Now, basically, what I foresee, there will be another category. There will be one debt funds where there's no indexation benefits. There will be another debt hybrid funds like we have today, debt hybrid fund where we are putting maximum 25% into equities. If that is taken to 35% plus, then that will enjoy the benefit of the equity, debt indexation. So that is something I think we will definitely look into. But that, of course, a new category has to be approved by SEBI. So we'll have to work with SEBI very closely on this. Keeping in view the existing tax laws now, some innovations will definitely come on board.
I just want to understand the taxation angle. Now till 31st March, the new tax change was not applicable. Now, if some investor wants to keep continuing their investment into any long-term category fund, what exactly will change at the time when they want to take the money out? Because that is when the tax will be applicable, right?
Yes, I mean, if you look at the way this is worded, I still have a couple of doubts on the interpretation of this thing, because see, this amendment which has been made has been added as a second explanation to section 50AA. Now this section 50AA, which was introduced in this budget, relates to market linked debentures till now. Now you have a separate category which has been added under this section, and this section says that mutual funds which do not have which have less than 35% equity will also be subject to short-term capital gains. Now, if I go back and read section 50A, it only says that it is applicable from 1st April 2023. Now, if I read the wordings of that section, what it talks about is only about sale of the instrument. And now the instrument includes market linked debentures as well as these specified mutual funds. My worry is this, that the mutual fund industry might today say that even if you invest till 1st April, it is fine, it is eligible for the benefit. The investor, when he sells the unit and then when he files his return, if this interpretation, which is there and which is not clarified by the finance ministry very clearly, which specifically excludes investments made till 31st March, then there can be problems as far as the taxation is concerned, because what if the assessing officer then rejects this and levies tax on the investor? Those cases are very, very common, because we have seen in the past with capital gains specifically, where the interpretation of the assessing officer or the income tax system is different from what one might normally interpret. So looking at these exact wordings as they stand right now from what I've read today, I still have doubt, and a clarification from the finance ministry would be very helpful, because we are in the last week of March, 7 days are left. If any planning needs to be done, this is the right time to do it.
Sir, what do you think? Do you have the same view as Arnav? Is it open for interpretation? DP sir?
Yeah. Actually, what Arnav is saying is fine, right. Actually, because this is coming under the section which is there for the MLDs only. But since the new category has been put in, and there it is specifically talking about the funds which are less than 35%. So I am taking it as an implied meaning that up to that date, I mean, as is there in the grandfathering has been given in the MLDs. So same thing will be here also. That's of course clarification will be more than welcome. But as far as I feel that I think it's clear that all the funds which will be coming from 1st April 23 will not be eligible for indexation. Whatever comes up to 31st March will continue to be there till the time these are withdrawn or these are redeemed from the mutual funds.
One more category, Dhirendra. Now, do you also think that it's time for insurance product and insurance investment products and bank FDs that will gain traction? They will become more attractive?
It could be a tactical advantage for them in the short run in terms of noise or creating a sales pitch. But I think it is very important for any thoughtful investor to be planning all these things carefully, planning your investments and planning your withdrawal, and planning your withdrawal not only in terms of what is right for you, what is best for you, what will optimize your return, what actually suits your temperament, but what is also tax efficient. And if you're not conscious of that, I don't think it is going to make a difference in the long run.
So, DP sir, now looking at the current interest rate scenario and the kind of debt mutual fund offering is there, okay, we just leave the taxation benefit that we had aside. In this entire category, what do you think investors should actually look in for? Barring the tax benefit that was obviously there, but in terms of the benefit of interest rate hike, and also a strategy as per their goal, especially if it is a long-term goal.
Yeah. So I echo what Mr. Dhirendra Kumar said. See, people are looking for different goals. People are looking for different avenues of this thing. And if you look at a category which has become very attractive nowadays, the target maturity funds. So people are trying to play duration there, because there's an anonymity that the interest rates have picked up, and in the next 1 or 2 years, the interest rates will come down. There will be huge capital gain. And that benefit still remains, right? And the liquidity is available. You can withdraw your money anytime, any point of time, during the course. And most of the cases, target maturity fund, the money is invested in government securities or SDLs, which are relatively very, very safe kind of investments. So those benefits still continue. And just looking at from the taxation point of view is not a right thing. But as again, what Mr. Dhirendra Kumar said, because of the short-term noise all around, There may be some short-term benefit, but eventually, I don't think that debt funds are going to lose the sheen, because the kind of benefits they are offering, which is the kind of liquidity, the kind of ease of operation, the kind of the instruments or tools like SWP, which can be used for tax efficiency, those still remain very, very valid.
So taking this answer only ahead, Arnav, how can one smartly make use of the kind of routes where you still have some kind of a tax benefit, like just SWP, which DP sir also mentioned?
Yes, so their mutual funds remain an instrument where you can plan very effectively. So, as mentioned, I mean, SWP is one of the best ways of doing it, because obviously, whenever you take out the money, instead of the entire amount being taxable, it is only the gain over the cost price which becomes taxable, which is where the real benefit lies. The other and most significant part of the tax benefit which comes in planning is that you do not have to actually pay the tax every year. You only pay the tax when you sell the units. Now, see, even though there is a lot of comparison between fixed deposits and debt mutual funds, this point remains a very important differentiator. Say, for example, you have a fixed deposit for 3 years and you are getting interest on it. Now, whether you like it or not, if the interest crosses the threshold mark, first of all, there will be a TDS. Second is that if you have to claim the TDS, you will also have to show it on an accrual basis, even though you might not have received it. So matching your TDS, ensuring that every year you are showing income, has to be done in the fixed deposit. When you are looking for a similar kind of investment in a debt mutual fund, till the date you sell it, the control of when the taxation will occur is in your hand. So you have full control over it. You can plan accordingly. Whenever either your income is less or you feel that you need to sell it, that is when the sale can take place. So these kind of differentiators are still beneficial for a debt mutual fund, and which is why that even though many investors might think that safety and surety is the hallmark of a fixed deposit, a fixed deposit gives you a return which you know beforehand. But from market movements also, if interest rates fall, you also have an element of slightly higher return which can come in debt mutual fund. So when you look at it on an overall perspective from the portfolio angle, there is a big scope for debt mutual funds to find a place there. The only thing is that after today's action, since the last few years, so much effort has gone into convincing and making retail investors understand about debt mutual funds, which by itself is a very difficult task because this is a slightly complex thing. Now, a lot of that effort has been undone because, again, for retail investors, understanding these complexities is slightly tougher. So that's the only thing. And the other thing is also the manner in which this has been suddenly inserted and not brought about in the direct finance bill. It one gives little room for discussion or even analysis, and then suddenly this becomes applicable. Those are the only what you call disappointing factors. But otherwise, as far as debt mutual funds are concerned, the scope is large. There is a room for it in your portfolio, and you just need to plan effectively.
Which we really missed in this entire chat, dampening sentiments for investment in gold and international FOF. Now, do you think it's time to just move on to sovereign gold bonds? Because otherwise, then the physical demand might just go up. DP sir?
To me?
Yeah.
Yeah.
Yes, sir.
Yeah, that's there. Because this FOFs and gold funds will definitely get hit in this, and sovereign gold bonds will definitely become attractive. But one thing, the sticker is going on your this thing, that the income on debt funds to be taxed as the interest income. So let me clarify: it's not going to be taxed as interest income, but it's going to be taxed equal to the interest income, but it will continue to remain the short-term capital gain. That's one clarification, because this stinker was going on your screen, so that I wanted to make. So that's one part. Second, yes, the fund of funds and gold ETF, gold mutual fund schemes will definitely become unattractive, and sovereign gold fund bonds are something which are of good attraction now. That's right.
Now, so it seems that it's time for investors to look into their investments, especially the debt investments. It's time for you to plan smartly. And although there is structurally or as per design, there is no fault in a debt mutual fund product. But then, yes, as far as the tax benefit is concerned, that goes away. All you have to do is just plan your portfolio once again, and the kind of bouquet you have in the entire fixed income option, you might just want to relook in terms of product categories that are aligned with your financial goals as well. Thank you so much, all of you, for being a part of this show. On that note, let's take a quick break, and post that, let's talk about how influencers are building social media empire.